So now as the next learning goal, we have to define cash and the cash equivalent, because there are some things that are quite, let's say, close to cash or quite similar to cash. And we have to define that in order to really understand the cash flow statement. So before we dive into, let's say, classifying, there's one opening task which I always really like, because here, before we do the task, usually the student think, oh, this is super easy to understand and super easy to determine. But after the task, the students find out, well, it's not as easy as it is thought to be. Because here we have a list of transactions or business events, like repaying, borrowing, and so on. What we should do in each of the cases, we should state if there is an immediate effect. So in each case, state the immediate effect, meaning increase, decrease, or no effect at all for both profit and cash. And then it actually becomes clear where the difference between the two is, because we have an income statement where we look at profit, and we have a cash flow statement where we look at cash. And there, sometimes you will see that there is a difference between the two, and then the difference between the two statements becomes ever more clear. Repayment of borrowings. So basically this means we have received from a bank or an investor money, and we repay this. This has no impact on profit because we simply give away money that we received earlier. But on cash, of course, this will decrease the cash because actually we're just giving away the cash. So we're giving away the cash to a bank or an investor. So this means cash flows out of our company, but it has nothing to do with profit, because basically it's just we received the money at a certain moment in time and now we give it back. Making a profitable sale on credit. Of course, this has a positive impact on profit. So if we have more, let's say, revenue compared to the cost from one sale, then this will increase our profit. So this means it's a profitable sale. So it increases our profit. Now the question is what happens to cash, and there's actually nothing happening because it's on credit. So we make a sale, we can recognize in the income statement that we made the sale, that we made the revenue. Of course, we match that to the according cost that we had for the sale. But basically, no cash is flowing into the company because simply the customer bought on credit. So we have, let's say, a trade receivable that is created. So we receive the money later. But at this moment, nothing happens with cash. Buying a non-current asset on credit has no effect on profit. And now you might think this is completely strange. Because if I buy, let's say, a car is a non-current asset. If you buy a car to drive to university, then this is not having any effect on profit. It's not a cost. And that is usually very strange to see. Because you would assume that if you, let's say, invest 10,000 euros to buy a car, that these 10,000 euros are actually costs, but they are not. Because if we buy the car, so let's say this is the car, then basically what we do is we have the 10,000 euros, which is the equivalent value to the car. So the car is worth 10,000 euros. But what simply happens is, well, you're exchanging assets. This is a non-current asset, and the cash that you have is a current asset. So you just give away 10,000 euros to buy the car, which is a non-current asset. So you get the non-current asset, but you give away the current asset. But there's no, let's say, cost involved. You just receive exactly the same amount as the value of the car than you gave for the car. So this means buying a non-current asset on credit, no effect whatsoever on profit. There's no cost which would, let's say, decrease the profit in the end. Because we said revenue minus cost is profit, and so there's no cost involved. And of course, if you buy the car, in this case, also no revenue involved. So no effect. No effect on cash because basically it's on credit. We have to pay it later. So there's no impact on cash immediately. That's why it says state the immediate effect, because of course later you're going to pay for the car. Then receiving cash from a trade receivable. So it's the counter transaction to this one. So now we actually get the money. So our trade receivables pay the money to us, which they still owe to us. So they needed to pay us, now they paid us. But there's no effect on profit. Why is that? It's because here already we recognize that there is a profitable sale. And here they don't buy again, but they simply pay us the money. So this means that there is a profitable sale, has already been recorded here. That's why now nothing happens. They simply give us the money which they should have, or they still needed to give us. So of course on cash it has an increasing effect, but on profit there's no effect. Then depreciating a non-current asset. That's also always an interesting one. So look at your phone. You take your phone, and what happens with your phone from year, let's say 1 when you buy it, to year 2 or 3, and of course after that it loses value. So it's not like and that's what I said before, I give the phone company money when the phone depreciates, but it simply loses value. So you bought it for 600 euros, I think that was the example I used the last time. It loses 100 euros a year, and then it's only worth 400 euros after, let's say, 2 years. And so this means depreciating a non-current asset basically leads to costs. So let's say the 100 euros that the phone loses value each year, let's say it's 100 euros, that's costs that you put in the income statement. So this basically means, yes, depreciating a non-current asset has a negative influence on the profit. Because basically we said that our income statement looks at, so we have the income minus the costs is the profit or loss. And if now our costs are increased by having depreciation, so a loss in value of the non-current assets, but there's of course no additional income if we depreciate the asset, then this has a negative impact on profit, so decreases our profit. But on the other side, there is no impact on cash, and that's what I just explained to you. You're not going to Apple, to Samsung, or to any other of the smartphone providers or producers and give them money for the depreciation. It just happens. Depreciation happens. So your car loses value, your phone loses value, but that's a non-cash expense, and that's very important to understand. It's a non-cash expense. So of course it is an expense that we put in the income statement, but it is not cash that we're using. And now it becomes hopefully clearer why this here is not an expense, because you buy the car for 10,000 and the car has a worth of 10,000. But the actual costs that we have are, of course you have different costs for cars, but the cost that we always think is the main cost. So if we say we buy a car for 10,000, we think, oh, that's a cost, right? But it's not. But most probably the cost that we're referring to is how much value the car loses over the years. So if I bought a car for 10,000 last year and now it's only worth 8,000, then these 2,000 that we have as a difference is basically the cost. And that's usually the cost that people refer to if they say, oh, we bought a car, that's the cost. But buying the car is not the cost, but the depreciation is the cost. So the loss in value that happens from year to year. So it's decreasing our profit, but there's no impact on cash. If we depreciate the asset, so the depreciation itself has impact on costs, like we just said, but there's no money flowing, is a non-cash expense. Buying some inventories for cash has no impact on profit because it's the same situation as here. Of course, now if we not use a non-current asset, a car, but if we're using inventories, let's say also we buy inventories for 10,000 euros, then here this is a current asset. And now it's the same situation as with the car. Basically, we just give 10,000 to receive value of inventories of 10,000. So it's just giving away one current asset to receive another current asset. So that's why there is no impact on profit. And then basically here, what we can say, of course, if we buy them for 10,000, if we use the 10,000, our cash decreases by 10,000 as well. So, of course, then it has an impact on the cash, but there's no impact on the profit. And then finally, making a share issue for cash. We didn't really dive into that topic yet, but a share issue basically means that, let's say we have created a company, let's say we have the Fontys Manufacturing Incorporated, and we now say we need more money. So either we go to the bank and ask the bank for, let's say, a bank loan, or we could also ask the public. So we could make, let's say, an initial public offering and tell, let's say, the market, we want to have more money and you can invest into our company. You can buy parts of our company, and that is called a share issue. So we actually want to get more money, but we give away, let's say, the ownership rights to other people. All right, we'll dive into that topic more in one of the later parts of the course, but just that you know this is what happens. And of course, this means that we get cash into the company, but there is no impact on profit. We simply give away ownership rights from our company to others, and we get money back. And this money back, of course, increases our cash. And basically with this, we have finished the opening task. And usually if we do this task in class, there are a couple of items which were not clear at the beginning, which are hopefully now a little bit clearer. Why is cash so important? Because why do we need cash? Why do we need cash to trade? Why do we need to make a cash flow statement? And the reason is, without cash or cash equivalents, a business cannot operate. And we'll have liquidity issues. We will talk about the term liquidity later a bit more, but liquidity also means how far you're able to pay your bills when they come in. Only cash or cash equivalents are accepted for settling claims. So if we are having a business partner, we're buying, let's say, the chocolate for our ice cream, because we're the Fontys Manufacturing ice cream shop, whatever, like we said the last times. If we are if we're buying our chocolate, for example, for the ice cream, we can only pay our business partners with cash. We can't trade a chicken or a computer for the chocolate, but we can only give them cash or money to settle our claims. That's why it's so important to be liquid, to have enough money to actually operate. And that's why if you have a super high amount of profit, but actually everything is on credit that you sell, and you have an issue with your customers not paying, which would be called a bad debt, or, and that's not something that we dive into in more detail. But if customers don't pay you, which can happen, that's called a bad debt. And then, of course, you're going to have a huge problem, because on paper you made a lot of profit, but your customers don't pay you. And then, of course, if you don't have enough money to pay your business partners, you might be bankrupt and out of business quite easily and quite quickly. So that's why cash is very important to have, be it on a cash account, be it on a bank account, but having money to operate your business. So let's now come to the actual learning goal, cash and cash equivalents. Cash are, and that's quite easy, all the notes and coins accessible for you on demand. So everything you have in your pockets or the company has accessible in the bank or somewhere stored in the company, in a safe or wherever they store the money. And cash equivalents are highly short-term liquid investments that can be easily converted to cash. So we remember short-term. Second of all, highly liquid, so you can easily turn them into cash. And there's a low risk of changes in value. And so on the next slide, we have a couple of examples, and then we have to see yes or no, are those examples cash equivalents? So remember, short-term, highly liquid, and low risk of change in value. So yes or no? Let's say the first example, a bank deposit account where 1 month notice of withdrawal is required. So you have to tell them 1 month upfront, I need the money, and then you get the money. Is this a cash equivalent or not? Yes, it would be cash equivalent, because a month is still a very short-term period. So a very short-term period. It's quite secure that if you put 100 euros on there, that you can withdraw 100 euros again. And it's, let's say, quite easy. You just tell them, I need the money, and then a month later you get the money. Number two, an ordinary share in a stock exchange listed company. So like I said before, if with our Fontes Manufacturing Incorporated, or we would already have a couple of shares on the market. And then there are a couple of companies or other people that invest into our company. Then the question is, if they invest into our company or if we invest into another company, it doesn't really matter. In general, if we have invested into shares of a company that is listed on the stock exchange, then is this a, let's say, cash equivalent or not? Well, let's have a look at short term. Can you withdraw the money? Of course, investing into shares might not be long term. It might sometimes be long-term investment, but of course you could get the money back quite quickly if you just say, I want to sell the share again to somebody else. You have the stock market for this, and so you could get rid of the share quite quickly. So, and you could therefore also convert it to cash quite quickly. But there actually is a quite high risk of change in value, because we all know these charts. So this is then, let's say, euros, and this is then the time or the month. And let's say here we started, and then it goes like this, and we're happy, and then it's like this because something happened with the company or in the market. And then let's say, of course, it can't go below that, but let's say here, what happens to our money is it basically, or the value in the share basically becomes worthless. Because something, like I said, happened, and here we would have nothing left. So there is a quite tremendous risk, or not tremendous, but it of course depends on the company, the industry, and so on, that there could be a slight change or a dramatic change in value. Of course, it doesn't have to be that dramatic, but it could also be like a small change, like this, even though that's also quite a radical one. But there is a change in value of the share. And that means, if we look back at the definition, there is not anymore a low risk of change in value, because this can happen. And then the value can change. So it's not a cash equivalent. And then finally, a high interest bank deposit account that requires 6 month notice of withdrawal, and 6 months is quite a long time. So we would not say that this is let's say, short-term investment as a cash equivalent. So here, no. It's not, even though you might, it depends on how secure this is. It might also be that, it's quite secure that you can get your money back, but it might also be that there is also a risk of change in value, but it's not short notice. So no, it's not a cash equivalent. And with this, hopefully it's a bit clearer what cash is, what cash equivalents are, and which impact cash has on a business.